Okay, performance fee only structures. I've talked about a little bit before. I like these a lot, and typically the only two types of deals we do are gross revenue royalty and performance fee structures. So we have a platform for investors. It's only for people who are allocating. It's not for anyone who has a fund, nobody who's syndicating, no one who has a company and raising capital, no placement agents. It's only for passive investors who want to allocate into deals. It's called investorclub.com. And we have a subdivision of that called Doctors Investor Club for dentists and doctors. And our only fee to our client there is a profit share. So what we've done is made it so that we can help those investors go into a couple of deals. And I want to share this because it shows how much I believe in this idea, because it's the only way that we work with our investors. We structure deals and help them allocate and source deals. And when they go into the deal, there's no cost to sign up with us. There's no cost to invest. The only cost to them, quote unquote, is a profit share. So if they put in $100,000 and they make $50,000, our fee to them is 10 or 20% of a profit share. So typically it'd be $5,000 if they made a $50,000 profit. And so we get paid on the back end only. And to make it more aligned, if they do 3 deals with us and one of those deals loses money, then our fees go to 0 on the other 2 deals till we make them back their money. So we can't be making money off of one deal that they did with us. Well, they lose their shirt on another deal they did with us. Luckily nobody's lost their shirt on any deals that they've done with us. But at some point, you can't predict every variable, and someone will get sick, or something, regulations will change, and something will hurt a business. And so we tried to design it to be have maximum alignment. I will say that a 10% only performance fee is super lean and too small for many types of deals. The only time where that makes sense is when you need to layer on top of somebody else's fee structure. If we are sourcing or structuring a deal and it takes a lot of time and effort and energy, a 20 or 25% or 30% profit share is much more industry standard. And right now we're just turning the wheel and building up momentum. And eventually I'm sure there'll be some deals where we do 33% or even 50% profit share structures on things. But 10% is often too lean. Some investors will balk at 40 or 50%. So, but if you do all of your deals at 50% profit share, you don't need to do as many deals. You don't need as many investors. So you don't have to work with everyone in the world. The point of today is to show you a lot of different ideas that will help you be more effective and close a higher percentage of meetings, attract more investor leads, or if you're an investor, to decipher the different types of structures and maybe focus on 1 or 2 structure types that you like best. Just like we like performance fee structures, gross revenue royalty structures. And personally, we've been focusing on a lot of medical, dental clinic deal flow lately, just because we work with about 100 dentists and doctors as clients as well. We got a question from Rick here about raising capital to buy a soccer club. We will be buying and selling players and eventually be selling the team as we increase the value of the team. Your recommendation on the structure. So Rick, in looking at what your interest would be in buying the soccer club and looking at what the fears of an investor would be, I would say that if this is an existing soccer club that's bringing in, let's say 10 million pounds a year of revenue and 2 million pounds a year of profit, and you're buying that soccer club, that you would have 1 or 2 membership classes for investors potentially, just considering this kind of off the cuff. If it's an ongoing concern with that level of revenue, you might be able to structure something so your investors coming in get a debt note and get paid back at 8% or 10% a year, plus have some equity warrants for when you sell the whole team later. And then they get an exit at that point on top of the 10% returns. They just get a few points of equity warrants or a gross revenue royalty. So they get 3% or 5% of the gross revenue royalties split up pro rata among all the different investors. If there's 10 investors that get 0.5% gross revenue royalty, calculated every month and paid out every month or quarter, until they get a certain return, whether that's all their money back off the table or 2 times their money back off the table, and you can have that trigger something if you want to. But the main point here is to see if you could structure it that way versus they're just sitting in equity and crossing their fingers that in 7 years you'll sell it and make them a profit. I think it'd be preferential to get investors their money back off the table, and they can go and put that money in the next deal while they have a little bit of equity with you still. The benefit to you here is that once you've gotten their money off the table, the pressure's off your back. There's no way to lose their money because you already got it off the table, and you have more equity in the deal potentially by using such a strategy, because it's a give and take of reducing risk for the investor versus the return they're getting. So it comes down to what types of investors you're dealing with. Some might demand equity and want equity. Some might want to be strategically involved. You might need 2 membership classes. Many people would probably, for this type of a business, not charge a management fee because it's not like a fund or an asset management need above running the business. It's probably would be raising capital for it based on the valuation of the current revenues. And then they would get a profit dividend based on where they are on the cap table that's paid out quarterly or annually. And then when you sell for a higher valuation, they would, receive the gains on that, ideally that price being higher than the price at which you're buying it for. Obviously that's how a lot of those types of deals get done. So if somebody invests and, the soccer team's worth $30 million and someone puts in $3 million, they own 10% of the soccer team. So 10% of the profit dividends go to them. And when you sell for 50 million, they're getting a $5 million payout at that time. So that's how a lot of those types of deals get done.